thank you everyone, like Lucas said, for being resilient and being here with me for a topic that usually is kind of boring with everyone, but we'll try to keep it short, and much has been already said, so I won't repeat it. So the point is, I have tried to give solution, taking a real example, and the example is real estate, because the real estate and the built environment are very significant, but also because there is a huge impact on the financial sector. So just to put a little bit of numbers around it, according to the chair of EIOPA, the mortgage portfolio accounts for Euro 7 trillion right now, which is 33% of the banking assets in Europe. And still, a huge portion, up to apparently 97%, is not energy efficient. And for linking this to all has been said this morning, this would expose banks to a potential loss of 900 billion for climate risks and climate event. Now, we have derived from all the conversation today that climate risk, climate, global warming, climate change, pose a fundamental systemic shift for all the planet. And we know, or the majority of us know, that traditional insurance is not working as efficiently as before. The built environment has direct or imposes direct exposures and indirect exposures to the built environment and to the finance sector, and this will be considered lately. But in all this kind of foggy future, there is a solution, and the solution is a new combination of investment for adaptation, for mitigation, and a new approach of insurance. So again, we know that including climate risk assessment and metrics is not a regulatory compliant anymore, is not a choice anymore, it's something that the market wants, that the investor wants. There is money, there is a need to finance, and we have to find a way to bring them together in a new way. So we know that there are physical risks, so I won't go into that. Once upon a time they were called act of God, because they were once in a while completely uncorrelated with anything that had to do with human activity. And the severity was big, but not huge, and the frequency was not so frequent, which is completely different from what is today. There are transition risks, and these are new because they pertain with the migration or the change of our economy into a lower carbon economy or net zero economy, and this implies risks that have to be considered. And for instance, if we look at the built environment, the non-green, according to whichever metrics, according to whichever investors, if the buildings are not green, they may suffer a big devaluation, and this will impact the loan-to-value. This will impact a lot of other stakeholders. There is the cost of energy. It has been considered also, so no news that. This is quite scary. Again, frequency, severity of the extreme weather events are increasing, and there is the huge losses. Just in 2024, total insured losses, $140 billion. It's huge for any kind of sector to be kind of becoming profitable or remain profitable. So what has been the response of insurers? Insurers have been withdrawing insurance. It is becoming more expensive, the covers are not as big, there will be assets that are deemed to be not insurable. In this scenario, just this Friday, Kurt, what's the name, Weinberger, something like that, sorry, I apologize for name, but he is the director for climate directorate at UL level. He was definitely saying that Europe is exposed to a global warming or an increasing temperature of 3 to 4 degrees. No matter what, if the global warming is kept at 2%. And he was referring that France was testing the NHS system and the grid system, the resilience of those to that temperature, and the results were not really positive. So we have to take that into account whenever we think about how to go and look at the future. Again, the insurance. How does insurance activate or being activated? When you have a physical asset, the owner is the one legitimate to cover its risk, its direct risk, with an insurance. The insurance may be large enough to cover all its exposures, or maybe not. And this will leave the other on the chain relatively unexposed, depending on which kind of contract there is between the lenders and the asset owners, and between the lenders and the lender of the lenders. So there is a chain of stakeholders that have to be taken into account, but only the asset owner can insure the asset. And the insurance can be available or not, can be expensive, more expensive, and that also impacts the default risk, the value of the asset, the value of whatever is the collateral. Okay. So, seems to be a green situation. We have key drivers, we have regulations. I don't want to go into that now. We have gone into that. There are case studies, there are examples where there has been requested lower capital charges to banks that were financing green investments. So green investments, we have heard, are interesting from a portfolio asset management, from the ones who have to invest directly into properties. So that's how do we do it? Now, how do we do it has a different approach, whether we go into the new buildings or we have to manage the existing stock. And we know that the existing stock more or less represents 80% of what we need. So we have to take that into account, considering that there is a financial leverage attached to that 80%. We are using still nowadays traditional metrics to use it. And investors, as we said, are more and more sensible to the ESG qualifications of those. There are new metrics coming as well. So the climate value at risk, which is value at risk metrics, which is applied to climate, specifically applied to climate. Now, how do we cope with that? Two things. One is cost sharing and the other one is risk sharing. Cost sharing means investment for adaptation and investment for mitigation. And both types of investment, the ones helping the transition to a lower carbon economy and the one that would aim at preventing or containing the damage of climate risks, are basically helping reduce the cost of insurance. And they call for what we say public-private finance. Now, this reminds me of something that happened in the past when fire at the plant were very common and they came to a point where they were difficult to insure. So insurance have started to ask for investment in adaptation and mitigation. Fire doors, sprinklers, team that would immediately understand how to contain the damage. That was bringing the premium insurance down, and over time it has more than repaid the companies for the investment done. This is something that we need to understand as an approach also for climate risk. But obviously the kind of investment are not to be borne by one single individual or one single company. That's why we say there must be an alliance of markets and stakeholders and aligning, and again, having the same metrics, sharing the data. Everything that we said before is applicable here and will ease the way. Now, data. We've spoken about data, and data seems to be the main point of discussion. But actually, if we think about aggregated data and aggregated portfolio, banks and investors more or less have already them. So it's not something that they don't know, because they have to report them. So it is possible that a first level of traditional insurance is not possible, it's too expensive, but it is possible to insure the second level. And this is something that investors should think of, or lenders should think of, because maybe by investing in that kind of insurance, they may have a capital relief that more than repay the cost of insurance. It depends case by case. You have to have clear triggers. So you have to understand what you have to cover, at which level, and why. And this brings me back to the intervention this morning of Nordea, because just to give you an example that is completely on the spot, he was clearly saying that one of the metrics that they use is the energy per square meter, or the GHG emission per square meter. Now, let's imagine that there is a portfolio of retrofit that has to be financed. So there is a need. There would be a clear indication of how to make it energy efficient in a way that Nordea, as an investor, would be likely to invest. And then you might have an insurance that would guarantee that that level of efficiency stays there. It's not only something that you have to keep, to reach, but you have to reach and keep. If for some reason this level is not there, you might have an insurance that covers for a certain period of time and brings you back, in order for Nordea not to withdraw the investment or not to, let's say, change the terms of the investment itself. This is something that would bring us to what we call a new kind of insurance, which is the parametric insurance, where you have a predefined trigger, very clear, where you have a predefined sum that has to be paid if the trigger is triggered. So that is something that in insurance world reduces the risk, because it reduces the severity, and you have only to deal with the frequency. But you have to deal in the frequency in a known environment where probably the energy efficiency has to be measured. So provided that you have data, provided that you have triggers clearly, you can design an insurance that works and is effective. So another way to look at that would be for a community to build floodgates. If the floodgates are built, then flood will become less of an uninsurable risk, and you can work out. So again, investment in adaptation, mitigation, and a new kind of insurance can be a solution and a way forward. Another way to go would be, and we go here aligning with the call for a capital market that is unified, risk pooling. Now, risk pooling is obvious. If you share the risk is lower, and the cost therefore should be lower. So if institutions, lending institutions, do trust themselves in a way that they can share the risk of the climate risk of their portfolio in one go, then a solution, an affordable solution, can be worked out. And this would be kind of going in the direction that we were saying this morning by putting all our strengths together, working towards one goal, making the capital markets more resilient, and ultimately move forward from this kind of uncertain situation. There has been a situation in which this has been done, like in Asia Pacific. Let me go on here. In Asia Pacific, one leading real estate investor suffered a 117% increase in insurance premium. Not doable, so something had to be done, and therefore what was done was some investment in adaptation and mitigation, and the price of the insurance came down by 10%. So it will be 10 years till when it goes breaking even, all other things staying stable. But again, it can be done. It will be economically viable. Usually, when you start in such a path, then the improvements accelerates, and therefore the insurance premium should decelerate more quickly. So probably the break-even will not be 10 years, but less. All this has to be, I wouldn't say invented, but worked in good faith among the whole line of shareholders in order to find a viable solution that is profitable for everyone. There are other examples, index-linked securities. I'm sure you all know about that. I'm conscious of time, and I'll be around for any other questions. Thank you so much.